You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to OIC's Wide World of Options. I'm your host, Mark Benzaquen. For November, OIC has a pair of webinars lined up discussing volatility products, namely volatility indices, futures, and ETFs. And to help highlight our upcoming presentations, I'm happy to welcome Ed Tom of Cboe's Market Intelligence team. Ed, welcome, and thanks for joining us today.
Thanks, Mark.
Ed, do me a favor. Before we get started, why don't you take a minute, tell us a little bit about yourself and your involvement or your experience in the world of options.
Sure. This is my 35th year in Wall Street. I basically spent my entire career working with equity derivatives and quantitative strategies. I started off at JP Morgan and then moved on to Salomon Brothers. I spent 20 years at Credit Suisse, where I was the global head of equity derivatives and quantitative trading strategies. The last 8 years I spent at different hedge funds, and most recently at Ellington, where I was there for 3 years, working on their downside equity convexity strategy.
Okay, and now you're with Cboe Market Intelligence. Tell me a little bit about that, please.
So basically, that's the derivatives research arm of Cboe. Where we basically provide market commentaries on volatility moves and different volatility strategies and products.
Okay, excellent. Thanks. I appreciate the background information. Speaking of Cboe, or Cboe as they're now known, as a representative from one of the exchanges that offer various volatility products, and seeing as how we're going to be talking about volatility products in our November webinars, I was hoping that you could walk me and our audience around some of the concepts surrounding volatility products. So let's go ahead and start at the beginning. And let's assume that we're talking to an investor that really has no idea about volatility products, what they are and how they work, but they do know about options. So, when it comes to volatility products, it's a little bit different, right? There is no stock that we're looking at. How do volatility products work in that sense? Can you be bullish or bearish on volatility?
Yeah, you can. So basically, taking a step back, volatility is essentially a measure of the stability of the markets. And in general, there's an inverse relationship between the performance of the markets and volatility. So if, let's say, the markets rise, generally volatility falls. And if the markets start crashing, then volatility rises exponentially. So basically, that's a general relationship, and that remains intact. I would say about 85% of the time. Mm-hmm. And there are products to basically express views on volatility.
Yeah, there's a saying that one of my colleagues likes to use, that the market goes up on a staircase and down in an elevator. That things crash, the market goes down much quicker than it goes up. So I understand that inverse relationship between volatility. So with that in mind, what are volatility products? Again, there isn't a stock, there is no XYZ volatility company out there. So what are volatility products? How do they measure? How do they work? Can you shed a little light on that?
Yeah. So basically, I think to start off with, we need to first discuss the industry benchmark for volatility, which is the VIX. So what the VIX is basically a measure of three things. It basically measures the volatility of the markets due to economic fundamentals. It also layers on top of that the relative demand for puts versus calls on behalf of portfolio managers.
Okay.
And finally, the third component is the additional premium that traders accord to a potential tail risk, a tail shock.
Okay.
So in combination, that's essentially what the VIX is.
All right. And the VIX, while it isn't the only volatility game in town, so to speak, as you had mentioned, it is an industry standard. So talking about volatility without specifically talking about the VIX, is kind of a hard thing to do. So what does the VIX measure? Or better yet, how does the VIX measure? So there's a value, right? That volatility index, there's a value each day. It's trading at X. How is that X, A, calculated, and B, what is it telling investors?
So I think to understand the VIX, we first need to kind of take a look at how options are priced. So options are priced using 5 parameters from the Black-Scholes model. Mm-hmm. And the one parameter that is not super transparent to most investors is volatility.
Right, not observable. Everything else, stock price, strike price, interest rates, dividends, those are all observable, quantifiable. Volatility, that's the guesswork.
Exactly right. Right. So basically, how volatility, implied volatility comes about is we observe the current price of a particular option. We plug in all the known parameters, including strike, tenure, et cetera. And then implied volatility is essentially the number that basically solves the Black-Scholes equation for that particular price. Mm-hmm. So basically what the VIX is a weighted average of implied volatilities across the entire S&P strike chain.
Okay. So it's the average price, or it's the average volatility level across all 500 components of the S&P? So we're looking at the S&P as a whole, right? And we're looking at all the listed strikes for any particular maturity. Okay.
So the VIX will be very close to the average level of the implied volatility of the S&P for any particular expiry.
Okay. prior to the creation of the VIX and prior to the creation of other volatility products, how did traders gauge volatility? Meaning that, now that we have the volatility indices, it fulfills a certain need in the market. What filled that need prior to the creation of these? Or better yet, what was that need that led to the creation of these volatility products?
Yeah. So prior to the creation of VIX, traders used to refer to realized volatility, which is basically like the same calculation that one uses for calculating standard deviation.
Okay.
But the problem with realized volatility is that it's descriptive, meaning that it's backward looking. And there was a need for a measure that was a little bit more forward looking. So that's how the VIX came into being, because implied volatility layers on some expectations or predictive components on top of realized volatility.
Okay. All right. I understand that. Let me shift gears for a second, and let's look at some of the other indices. For example, the S&P, again, a benchmark index that people use. There is no stock. There is no S&P 500 stock. How does, when it comes to a volatility index, how does that work? There's a futures contract as well, I assume. Not I assume. I know that there's a futures contract as well. What does that futures contract, if I buy a futures contract in a commodity such as, oil, I know that at the end of that term of the contract, I'm going to end up with 25,000 barrels of oil on my in my backyard if I let that contract go through to expiration. What do volatility futures? What is the end game, or how do those work?
I'm glad you bring up oil futures, because I think that's a very good analogy. When we look at, let's say, S&P futures, that's a very simple type of future to understand, because it's known as a cash and carry instrument, meaning that if you buy the spot and then you basically invest that money into you sell the S&P spot and then you invest that money into the bank. At some future point in time, you know exactly how much the value of that holding will be worth, and that will be is basically the price of the S&P future. But with VIX futures, there are a couple of different other components that are added to the cost of the future based off the current price of VIX, and a good portion of the premium that is accorded to VIX futures is based off of the expectation of traders of what volatility will look like at some future point in time, and also the demand for volatility at that future point in time. So basically, there's a mathematical component, and there's also a supply and demand component that is accorded to VIX futures. Okay.
And when it comes to VIX futures, they're a little bit different than a typical futures contract in the sense of, back to S&P, for example, those are quarterly futures, right? I think they're listed in, December, March, June, and September. Those are the 4 quarterly futures for the S&P. But with the VIX and other volatility products, I believe it's different. There's monthly contracts. So, for example, what I find interesting is if you're trading a time spread, right, a calendar. If we had a March, April, calendar or diagonal on in a volatility product such as the VIX, we would have the March option would be tied to a March future, and the April option would be tied to an April future. Do I understand that correctly?
That's correct. That's right. Yeah, and basically, that's how traders have been expressing, let's say, the upcoming presidential elections. They basically trade a calendar spread on either the October-November term structure, or they trade the November-December calendar spread.
Okay, so yeah, and that brings up a good point. For a investor interested in trading a volatility product, are they mostly looking to capture differences in volatility, changing volatility, or might they just buy some calls on a volatility ETF or an index, just as they would stock XYZ, with the expectation that volatility is going to increase? So is that for that average investor, is that kind of a way that they might take advantage of volatility and trade the VIX or trade a different volatility product? Or are there maybe other reasons? Are there other things that they're hoping to accomplish?
Yeah, so basically, I think that in general, your statement is correct. But the tricky thing about trading VIX futures is that the benchmark isn't the current level of VIX, but rather what traders have already priced into that future price of VIX. So, for example, right now the current level of spot VIX is 17.
Okay.
So one might think, okay, well, you know what? I think that the November elections will cause an uptick in market volatility. So I'm thinking to buy November expiry VIX options. The problem is that at this point, volatility traders have already priced in an additional premium for November. So the November futures contracts might be higher than 17. So let's just say that it's 20. Okay. So in order for an investor to actually profit from a view on November VIX contracts, the VIX futures need to rise above 20. Basically, it needs to exceed the level that's already being priced into the markets.
Okay.
Yeah.
So are you saying that that's kind of like maybe even a break-even point, that it needs to be above or below that point in order for the trader to profit?
Yeah. So basically, like if you plan to unwind prior to expiry, that is true. Yes.
Okay.
If you hold to expiry, then the effect is a little different. Then the thought is that, okay, well, then the benchmark really is spot VIX.
Okay.
But for most investors, one tends to trade to basically monetize their gains pretty much immediately after the event.
Okay. Speaking of spot VIX, you had mentioned spot VIX. You had mentioned it's currently trading around 17 or so. Well, let me ask you this. Typically, when I think of implied volatility, right? Not a volatility product, but the concept of implied volatility we talked about earlier. If implied volatility is 17%, it's telling us that according to how the market is pricing this particular option, they're expecting a 17% move up or down in that underlying over the next 12 months. That's kind of an idea of implied volatility. With the VIX trading 17, as you had mentioned, does that concept still kind of hold true? Is it saying that the market is expecting a 17% swing as evidenced by that VIX number, or is it telling us something completely different?
Yeah, I think that's close enough.
Okay.
But I think a better way for most investors to kind of to grasp the idea of a 17 VIX is basically to use something called the rule of 16, which is basically a way to convert an annualized volatility number into a daily move.
Right. Square root of trading days in the year, typically 252. Comes out to roughly 16, hence, for our listeners that are wondering what we're talking about, hence the rule of 16.
Yeah, exactly right. Right. So basically, the rule of thumb is that an annualized volatility level of 16 equates to about a 1% move per day. I think for most investors, that's an easier way to kind of like translate the current level of VIX to like a more understandable move.
Okay, understood. Thank you.
Yeah.
So volatility indices, volatility futures, we've got ETFs on volatility. These are all different products, but all really kind of try to accomplish the same thing, which is providing investors a vehicle in which to hopefully profit on whatever their forecast may be. And one of the interesting things, again, getting back to implied volatility, is that because it's not quantifiable, it's not observable, as you had mentioned, that is a point of contention amongst investors. If you think volatility is 20% and I think it's 25, we each have our different models, whether they're proprietary algorithms that we run or what have you, whatever our pricing models tell us, if you think it's 15, I think it's 20, or you think it's 20, I think it's 25, the difference in volatility, the difference of our opinion is going to be reflected in what we think of the fair value of that option contract. Now, the volatility products, again, back to the VIX, for example, does that work similar to where, well, the VIX is trading 17, I think it should be much higher, or I think it should be much lower. So because of that, it's going to affect my pricing models, and therefore it's going to maybe form a strategy, a trading strategy where I'm buying or selling. Are there those differences of opinions in the VIX as well, or vol futures, vol ETFs? Does it kind of work that same way, where you think one thing, I think something else, and therefore we've got a trade, or is it? Am I completely off the mark on this?
It totally does. So basically, I think that for most investors, it's easier to kind of like express a view on where the S&P is going to be at some point in the future, and whatever that level is, there's a certain market for the probability that the S&P goes to that particular level. That level, that basically the probability is impounded into the implied volatility for that particular strike. And if you were to basically like visualize all those implied volatilities by strike, we would form what's called the S&P implied volatility skew. And all the differences in opinions basically changes the implied volatility skew, which again, taking a step back, is basically the differences of demand for different puts versus different calls along the S&P strike chain. So the skew can rise and fall depending upon traders' views of the likelihood of a downside shock or an upside rally in the S&P. And basically the way that the skew kind of like behaves will be an aggregation of all those different opinions amongst volatility traders.
Excellent. Okay. Well, thank you. That makes sense. Ed, excellent information. I really appreciate it. Thank you for sharing that with us, and thanks for agreeing to guest on the show. Much appreciated your time. Thank you.
Okay, great. Thanks, Mark.
Well, folks, that's going to do it for today's episode of Wide World of Options. Special thanks to our guest, Ed Tom from Cboe, and taking the time to sit with us and talk options, and for his insight into the world of various volatility products. Please join us next time when we're going to be back with a whole new show featuring more industry names, market concepts, and of course, trusted options education. In the meantime, be sure to visit the events section of our optionseducation.org website to register for our upcoming webinar events, and feel free to explore the rest of what OIC has to offer while you're there. Thanks again to all of our listeners and supporters, and as always, please feel free to send us your questions via email at options@theocc.com, or you can live chat with us on our website. Take care, everyone, and we'll be talking with you again very soon.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.